Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, let's just get right into the numbers from the close of trading Friday, February 6th, 2026. We are looking at SABR Corporation, ticker SABR. The stock closed at, $1.18. Now that's a daily surge of 7.73%. We saw some significant volume, too, about 6.94 million shares changing hands. That brings the market capitalization to roughly $467.94 million. I think the market is finally waking up here.
The market might be waking up, or it might just be, twitching in its sleep. Let's add a little bit of cold water to that Friday bump. I mean, even with a 7% rise, we are hovering dangerously close to the 52-week low of $1.07. And if you zoom out just a little bit, we're looking at a 64% decline over the trailing 12 months and, well, a staggering 90% drop from its all-time highs back in 2015. So technically speaking, despite the price action on Friday, this is still a stock trading well below its 200-day moving average of $2.11. It is firmly in strong sell territory for pretty much every technician on the street.
And that is precisely where the opportunity lies. We are talking about SABR Corporation today. The frame I want to present and the reason I think this is a buy right now is that this is a story of a legacy giant executing a massive high-stakes pivot. I mean, we are moving from a legacy GDS infrastructure to agentic AI and cloud-native architecture. The market is pricing this company for bankruptcy, and it's effectively ignoring the strategic moves they've made just to survive.
See, I come at it from a totally different way. I don't see a misunderstood tech pivot. I see a distressed asset with a, frankly, broken capital structure. We're looking at a company where the debt load is absolutely massive. The book value is negative, and the technological promises, while, interesting, are being made against a ticking clock of solvency. This isn't about AI. It's about whether they can pay the bank.
Well, I think that's the conventional fear, and honestly, it's what's keeping the price so suppressed. But let's look at the actual position. The whole bear case relies on this idea that SABR's just going to run out of runway. But look at what they've actually done. They successfully executed a debt restructuring that pushed the majority of their maturities out to 2029. That is a 3-year window of breathing room. And they made the hard choice to divest the hospitality solutions business to TPG for $1.1 billion.
Which was a fire sale. You cannot convince me otherwise.
It was a strategic realignment to save the ship. That liquidity allowed them to prepay over $1 billion in debt. Now the company is laser-focused on travel solutions and SABR Mosaic. They are betting everything on the transition to NDC, new distribution capability, and agentic AI. And you know what? The core business is stabilizing. Distribution revenue actually grew 4% in Q3 2025. Booking fees are up to $6.05. The pulse is there.
You call selling hospitality a strategic win? I call it a desperate necessity. That segment was growing at 7%. It was the one part of the business with genuine momentum, and they had to sell it just to keep the lights on. And let's talk about that breathing room. The balance sheet is terrifying. We're talking about $4.22 billion in debt against a market cap of under $500 million. But the single most damning metric, the one that keeps me up at night, is the interest coverage ratio.
Which you're calculating at what?
It's 0.801. Based on the Q2 numbers, they had an operating income of roughly $89 million against interest expenses of $111 million. They are not generating enough operating profit to cover the interest payments on their debt. They are borrowing or burning cash just to service the debt. And that successful refinancing you mentioned, the new 2029 notes carry an 11.125% coupon. That is junk bond territory. That's the credit market screaming that this company is in distress.
It's certainly high yield, I won't deny that, but the coupon reflects the risk at the time of issuance. The bet now is on the operational turnaround changing the cash flow profile before 2029 arrives. And that brings us to the core of the business model transformation. This isn't just about cutting costs. This is about the shift to agentic AI.
Everyone is talking about AI. It's the buzzword of the decade.
But this is specific. We aren't talking about generative AI that just writes text. SABR is deploying agentic AI. These are agents that actually execute tasks. We're talking about an irregular operations proxy that can wait on hold with an airline to rebook a flight so a human doesn't have to. We're talking automated expense filing. This is real operational utility. They've invested in BizTrip AI, which is a major catalyst for Q2 2026. Plus, the partnership with Google Cloud is real. It has already delivered a 6 percentage point improvement in margins and $27 million in cost reductions. They're modernizing the engine while the plane is flying.
The problem is that the passengers are parachuting out while they fix the engine. Let's talk about the demigration reality. You mentioned the Google partnership, but look at the IT solutions revenue. It was flat at $140 million. Why? Because airlines are leaving. They are moving away from SABR's legacy systems like SabreSonic to in-house solutions or to competitors.
That's a known headwind, but
It's a structural failure. If you are losing your core airline clients, it doesn't matter how good your agentic AI is at rebooking flights, the underlying infrastructure is shrinking. You're celebrating a 4% growth in distribution, but IT solutions is stagnant because new wins are barely covering the losses from clients walking out the door. Is a chatbot that waits on hold really enough to stop a major carrier from migrating to Amadeus?
It's not just a chatbot. It's an entire ecosystem shift to the SABR Mosaic platform. But, since you brought up Amadeus, let's talk about the valuation gap, because it is glaring.
I suspect I know where you're going with this.
It's undeniable. SABR trades at roughly 1.68 times enterprise value to revenue. Amadeus IT Group trades at 4 times. You have a massive disconnect there. Even if you discount SABR for the debt, the spread is just too wide. SABR still holds 30% market share. It is a member of the GDS triopoly. And they have a unique edge in Asia. SABR is the only global marketplace with access to 100,000 Chinese hotels via their recent expansion. If you believe in a global travel recovery, specifically in Asia, SABR is the cheapest way to play it.
You cannot compare SABR to Amadeus just because they are in the same industry. That is like comparing a distressed municipal bond to a U.S. Treasury. Amadeus has a market cap of, 22 to 26 billion euros. They are profitable. Their EBITDA margins are 38 to 39%. They are a compounder. SABR is a distressed asset.
But the gap implies SABR is going to zero.
The gap implies SABR has a negative net cash position of minus $3.56 billion. That is nearly $9 of net debt per share. When you buy Amadeus, you are buying a cash-generating machine. When you buy SABR at 1.68 times revenue, you aren't getting a bargain. You are taking on a liability. Amadeus is growing double digits and paying a dividend. SABR is selling off limbs to pay the interest. They shouldn't trade at similar multiples.
I agree they shouldn't be equal, but the current discount price is in total failure. And the so-called smart money doesn't seem to think failure is imminent. Look at the institutional ownership. We just saw Glycerin Group LP file a 13G showing they've taken a 9.8% stake. That's nearly 38 million shares.
That is a significant position.
It's massive. And you still have Vanguard and BlackRock holding, although BlackRock's value's down, sure. But when a fund like Glycerin steps in with almost 10% ownership, they are not looking for a quick trade. They see deep value. They see a company that is indispensable to the global travel economy, trading for basically option premium prices.
I look at the institutional data, but I prefer to look at the people who actually run the company. Let's analyze the insider trading timeline because it tells a very specific story. You had a cluster of buying in May 2025. EVP Roshan Mendes, several directors, they all bought in around $2.95.
Which shows conviction.
It showed conviction at $2.95, but what has happened since? The stock has dropped another 50 to 60%, and the buying has stopped cold. There were 0 insider buys in the 3 months leading up to February 2026. And optically, it looks terrible that the CFO, Michael Randolphi, sold shares in September 2025.
That was likely tax-related or programmatic.
Likely, yes. But when your stock is trading near $1, and your CFO is selling even a programmatic block, it sends a signal. If the turnaround was so obvious and the stock is so cheap at $1.19, why aren't the insiders averaging down? They bought at $3. Why not back up the truck at $1.19? Their silence is deafening.
Well, insiders have windows, and they may be restricted ahead of the upcoming earnings. Which brings us to the catalyst. The February 18th, 2026 earnings call is the moment.
It's certainly a binary event.
Management has set a target. They're aiming for $70 million in pro forma free cash flow for the full year. If they hit that number, if they can show the market that the cash bleed has stopped and they are actually generating positive cash flow, the entire short thesis just collapses. The debt becomes manageable, the equity re-rates.
I have to stop you on pro forma. We need to be very careful with that term. GAAP net income is still deeply negative. In Q2 2025, they lost $256 million. Pro forma adjustments often strip out the very real costs of restructuring and stock-based compensation.
But cash is what matters for solvency.
Agreed. But that $70 million target relies on everything going right. It relies on NDC adoption hitting critical mass. Currently they have 42 airlines, which is good, but it's not total coverage. It relies on the Google Cloud savings materializing exactly as planned, and it relies on no macro travel recessions. They are trying to thread a needle in a hurricane. This 2026 vision is executing against a wall of 11% interest debt. If they miss that cash flow target, even by a little, the math just stops working.
It is a tightrope. I'll admit that, but look at the upside. We're talking about a company that powers the back end of the entire travel industry. You mentioned the Reddit sentiment earlier, the whole bottom fishing narrative.
Right, the AI value buy.
It's easy to dismiss retail, but sometimes they sniff out asymmetric risk before the street does. If SABR Mosaic works, if the Chinese hotel inventory comes online, and if they hit that $70 million cash flow number, you aren't looking at a 20% gain. You're looking at a multi-bagger from these levels. The relative strength rating has already improved from 78 to 83. The stock is showing resilience even as the news remains mixed.
Resilience or stubbornness? I see a company with a negative book value of minus $2.45 per share. Think about that. If they liquidated the company today, shareholders would owe money. Theoretically speaking.
That's a backward-looking metric for a software company transitioning to the cloud.
It's a metric of solvency. My summary is this. SABR is an option on survival. It is not a value investment in the traditional sense. The pivot to AI is promising, sure. The technology is real, but the financial runway is terrifyingly short. The interest coverage ratio being below 1 is the single most dangerous metric I have seen in a company of this size. Unless they can fix that and fix it immediately, the equity is just a placeholder for the creditors.
I see the risk, but I maintain that the asset is indispensable. You cannot simply rip SABR out of the global travel ecosystem without causing chaos. The divestiture of hospitality provided the liquidity they needed to get to 2029. That is the key. They bought time. Now with the Google partnership and the high-margin booking fees rising, the re-rating from $1.19 could be massive. I think the market is too focused on the legacy debt and ignoring the future margin potential of the AI transition.
We're going to find out very soon.
We are. February 18th. That earnings call is going to dictate the next 2 years for this company.
It's going to determine if this is a tech turnaround or a debt restructuring and waiting.
Precisely. And that is where we leave it. A legacy giant on the brink of either a renaissance or a reckoning.
And a $1.19 stock price that could go either way, fast.
Watch the cash flow. That's the signal.
Watch the interest coverage. That's the reality.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.